Is the stock above the strike price? Well, the market value is 42, while the strike price is 40. And since the stock price is above the strike price, the call is in the money. Let's do a second example. The investor has sold an ABC March 160 call when the market value is 171. Again, we note that this is a call option, and think call up. The market price of 171 is above the exercise price of 160, so the call is in the money. Let's do one more. An investor writes a PDQ August 70 call when PDQ is worth 64 in the open market. And once again, we have a call contract, so call up is the rule. But in this case, the market value of 64 is not above the strike price of 70, so the call is out of the money, not in the money. Note that we did not consider in looking at these problems whether an investor was a buyer or a seller when applying the rules as to whether a call option was in or out of the money. All that mattered was that it was a call option and whether the market value was above or below the strike price. Now, you didn't have to worry about whether the investor was a buyer or a seller in that particular problem. So it's important to note that don't get confused as to whether someone is a buyer or a seller when trying to determine whether a call option is in or out of the money. Just think call up. Is the market value above or below the strike price of the option? Now, if we think about what we've examined so far, it would seem we have a little problem here when we think about the situation that the writer of the call option is in. We're going to try to figure out what's the motivation for doing this, because so far we figured out is that if you write a call option and take on the obligation to sell stock at some fixed price, let's say $50 per share, the only time you'll have to go through with that obligation is if the stock in fact rises above the strike price. So you would have to buy the stock at this higher price in the market and sell it at this fixed lower price, the strike price. Now remember that if the stock in fact fell below the strike price, nothing would happen. You wouldn't have to go through with the exercise. You wouldn't be selling stock. So why would the writer of the call take on this obligation to sell stock when they'll only have to do that when the conditions are to their disadvantage? Well, there is an incentive that we should look at. And in return for providing to the buyer the right to buy stock, the owner of the call then receives that right, and presuming the obligation to sell, the writer receives a one-time upfront payment, which we'll call the premium. The call writer can keep the premium regardless of what happens to the option later on. Now, before discussing this premium in more detail, we should describe how these dollar amounts, these premiums, are quoted in the market so that we can understand them. For example, we might see an XYZ November 40 call at 5. The premium for this option then, we might say, is 5 points. Well, what does that mean? Well, it means that for each of the 100 underlying shares, the buyer will pay $5 to the writer. So our total premium would be $500 in this case. Now, premiums can also be quoted with fractional amounts. Suppose an ABC March 160 call has a premium of $14.50. What would that premium be? Well, to find out, multiply $14.50 per share times the 100 underlying shares for a total premium of $1,450. Now we have seen that premiums can be quoted in fractional amounts. And a common issue with fractional amounts in the securities industry is what's the minimum change in fraction amounts. So if I had $14.50 as a premium, what would be the next biggest premium that I would be allowed to quote, to buy, or to sell at? And it would be $14.51. In other words, usually you can change premiums on options by increments of as little as 1 cent. But usually we will be looking at changes of a few cents up to changes of dollars and cents. Now that we know how to quote a premium, a critical question is how do we determine how big that premium should be? What should the writer receive from the owner of the option in return for providing the right to buy or sell to the owner of the option? So we need to figure that out. What is an appropriate size premium? Well, a good thing to do in this case is to consider that a premium can really be viewed as compensation to the writer of the option for the risk that they're taking. And remember, if we think back to the writer of the call, they're taking a risk that if the stock goes up, they'll have a loss, that they'll have to acquire the stock at a higher price in the market. So the premium compensates them for the risk that they might be taking in assuming this obligation. So let's take a look at an example and see how we might work through what the premium should be. Suppose an investor writes an uncovered XYZ January 50 call. Now remember what that means. They have an obligation to sell stock at 50 if they receive an exercise notice, an assignment. At the time the investor writes the call, let's assume that the XYZ stock is selling for $54 per share in the open market. And notice that the investor has agreed to sell XYZ stock at $50, the strike price, but the stock is already trading for $54 in the open market. So if an assignment occurred right away, you'd have to buy stock at $54 and turn right around and sell it at the lower price of $50, losing 4 points per share on 100 shares. So the writer is immediately subject to a potential loss of 4 points, or $400. This immediate risk to the writer is called the intrinsic value of the option. It is exactly equal to the amount that the option is in the money. Now, if we look at the situation, if you're taking this immediate risk that an exercise might occur, it wouldn't make any sense for you to agree to take on this obligation to sell at $50 when the stock is at $54 unless the premium to be paid to you was at least 4 points in this situation. Otherwise, you're going to wind up with almost an immediate loss on this transaction. So at least 4 points of premium would offset the potential loss that you might have immediately on the option. So let's look at another situation. Suppose we took the same investor, the writer of the January 50 call, and assume that the stock is at $48 per share, lower than the strike price. Is there an immediate risk that the option might be exercised? Well, no, not in this case. Remember that the owner of the call is not going to exercise it if the call is out of the money, which it is here. So it wouldn't make any sense for the owner to exercise it. So there is no immediate risk to the writer. We would then say that the option has no intrinsic value, that it is zero intrinsic value. So it looks like an option does have intrinsic value when the option is in the money. In the call option case that we're looking at here, that would be when the stock price rises above the strike price. On the other hand, if the stock price falls below the strike price, then the option would be out of the money and it would have no intrinsic value. Now, we would expect that the writer would demand a premium that is at least as big as the intrinsic value of the option. But is that all that we should demand? Just the intrinsic value? Well, consider the following problem. We again assume the investor has written a January 50 call when the stock price is at $54. Again, they're assuming the obligation to sell stock at $50. The stock is already worth $54 in the open market, so the option should have 4 points of intrinsic value as we mentioned in our previous example. Should the investor be satisfied with a 4-point premium, or is there an additional risk that should be reflected in the premium? Well, if it's true that the writer is subject to a 4-point risk at the present moment, the writer will continue to be subject to assignment through January expiration. And what would happen if the market value rose even higher between now and expiration? The writer would be subject to even more risk. So this extra future risk is called time value. The writer must try to estimate that